You're watching episode 59 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning into today's episode of the Tax Smart Daily. I'm Brandon Hall, a CPA and a managing partner at the Real Estate CPA. And before we get started, I invite you to join the Tax Smart Facebook group. A link to join that is below in the description of this video. We're having a lot of really fun conversations about tax and accounting, and I invite you to come be part of the conversation. Today's topic is coming on the heels of yesterday's video about investing in syndications as limited partners. I kind of want to talk about the GP side, the general partnership, if I'm the sponsor, that type of side of the deal. And this is going to be important for anybody that's syndicating deals or anybody that's investing in a syndication to know at the end of the day. So when I'm a general partner in a syndication deal, I might put up some capital, but after I build a track record up, I'm really not going to put a whole lot of capital up into any one of my deals. My track record's going to speak for itself. The money is going to be abundant, that I'm going to be able to raise anything that I ask for and acquire any deals that I want. But one of the questions that we often get is, what happens to all of the tax losses coming from the bonus depreciation once we get a cost segregation study done? And the answer is that it really depends. It depends on how you structure your operating agreement. A lot of syndicates will pass the losses back to the limited partners, but sometimes the losses actually exceed the limited partner's ability to take losses. Now, what do I mean by that? Well, if I'm a limited partner in the deal and I put $100,000 into the deal and then I'm allocated a $100,000 loss, my capital account is now $0. I put $100K in and then I'm allocated the $100,000 loss. If there's more losses to be allocated, then I can't be allocated those losses because my capital account will then be negative. And so every once in a while, we'll run into situations with clients where we actually have losses that are larger than what all the limited partners contributed to the deal, which means that we have these losses that can't be allocated to limited partners. So the question becomes, what happens to those losses? And it's really important for general partners to understand that qualified non-recourse debt is non-recourse debt, but secured by real property. And there's a couple other qualifiers, but most real estate investments are secured by qualified non-recourse debt. And qualified non-recourse debt gives you basis to claim tax deductions. So if you're allocated any qualified non-recourse debt, then you can be allocated tax losses even though you put $0 into the deal. Because when you're allocated qualified non-recourse debt, it gives you basis to take deductions. So if I put $0 into the deal, but I'm a general partner and I'm allocated $4 million of the qualified non-recourse debt, or maybe I even personally guarantee it and now it's recourse debt, even though I put $0 into the deal, technically I have at-risk basis thanks to this qualified non-recourse debt or thanks to this recourse debt to take losses. So if we structure the deal in such a way where none of the qualified non-recourse debt is allocated to my limited partners, and we have these losses that exceed the limited partners' aggregate capital account contribution that they made whenever they invested, then I have these extra losses, these extra tax losses that I can claim even though I put no money into the deal, because the qualified non-recourse debt gives me basis to claim those deductions. Now, if everything that I just said is like over the top confusing, if you're on the GP side, you really need to understand this because it can help you structure more tax efficient operating agreements. If you're on the limited partner side, you really need to understand this because you need to understand what the GP is getting out of the deal. And so understanding the tax flows here will help you understand what the economic incentive is for everybody in the deal. Now, we go through this in detail in the content that we're releasing on taxsmartinvestors.com. So if you go to taxsmartinvestors.com and you subscribe to at least the content subscription, you'll see some of this content coming out. We're releasing one a little later today, actually. So you'll be able to kind of dive into it a little bit more and understand exactly where everything's going. But otherwise, what you need to know is that a general partner can put $0 into a deal and they can still claim losses. If everything flows correctly, they can still claim losses, tax losses, even though they put $0 into the deal. And they can do this because they are going to be allocated some amount of that qualifying non-recourse debt. So you just got to watch out for it if you're on the limited partner side. It's not a bad thing. You just need to understand who's getting these tax losses. And then if you're on the general partnership side, if you want the tax losses, you can just clearly communicate this to your real estate investors up front, show them how it works in the operating agreement, and you're going to be ready to rock and roll. Thanks so much for watching today's complex episode of the Tax Smart Daily. If you have any comments or questions, drop me a line below, and I'd love for you to follow us online. We have a links to all of our social channels below, so please join our larger community.